Welcome back, dear students, to our final presentation on bonds. And so we're going to discuss the yield spreads, the yield curve, what it has to say about our economy, and then take a look at a valuation model for bonds, finish up with a few odds and ends, and we'll be done with bonds. Yeah, okay, anyway, slide 20. Yield spreads are the differences in interest rates that exist among various sectors of the bond market. In general, the shorter the maturity, the lower the rate, the longer the maturity, the higher the rate. And that makes sense when you think about it. Why? The longer the money is out there that you've lent, the more opportunity for things to go wrong. That's why your mortgage company, your credit union, your bank, will charge you a lower interest rate if you get a 15-year loan than if you get a 30-year loan. And the higher the rating of the bond, the lower the interest rate and vice versa. And again, that makes sense too. The higher the credit quality, the less interest the bond issuer has to offer to potential bond investors. The lower the credit quality, just as what the bank will do to you if your credit history is not good, they're going to charge you a higher rate. And then, of course, there's the pecking order amongst treasuries and municipal bonds and then corporate bonds. And that all makes sense. So here, and then you might not be able to see this well if you're on a smaller screen, but there's a link to this web page. And Fidelity is actually a very, very smart company, very adept at serving their clients. And they have a dynamite bond website. If you sign up for their brokerage account, I know you think you're dealing with Fidelity mutual funds, and you kind of are because they're sister companies. They allow you access to tens of thousands of bonds. So pretty darn cool, because most people just figure, you have to go get a bond broker, but no, Fidelity will handle it for you. And so we see that the sooner the maturity, the shorter the duration to maturity, the lower the interest rate, and as you move out, you get paid more and more. And I want to know who's taking on a 30-year treasury bond at 2.08%. 30 years, you're going to lock in 2% for the rest of your 30 years. Oh my goodness. But notice as you go down the risk versus reward, there's corporate, the spreads are not that great actually. Well, here you are. You'll get 5% if you take out a 30-year corporate bond, but that's at its lowest, the lowest investment grade, BBB. Yeah, not the greatest of interest rates these days. And then there's the municipal bonds paying less than the corporate bonds, and that makes sense. So these spreads make sense. They're low. The interest rates are low in general, but it makes sense. Things are normal, and we'll see sometimes things are not normal. And what does that mean? So often investors will speak about the bond spreads as being tight or wide. So a tight spread means the interest rates among the bonds they are evaluating are very close to one another. So say a treasury is paying us 4.8%, corporate bond is paying us 5.1%. That's a pretty tight spread. A wide spread means there's a big difference between bond interest rates. Treasuries, say, paying 3.2%, a corporate bond paying 8.2%. That's a huge spread. And you'll hear them talk about it in terms of basis points. So here between 3.2 and 8.2, between 3.2 and 8.2, that's 5%. Now, they don't say that. The pundits on the Infernal Net and on the telly will say 500 basis points. 1 basis point being 0.01. And you'll figure that out if you listen to these these individuals for some time. Whereas here, 4.8 and 5.1, that's only 30 basis points. 0.3%. For several years, bond spreads were very tight. During the turmoil of 2008, 2009, the yield spreads widened to levels not seen in decades. There was the flight to quality, and the treasuries plummeted, whereas sometimes people were actually paying to have other people borrow their money. Figure that one out. They were getting negative interest rates, and some places around the world they still are. But the corporate bonds and the muni bonds exploded on the upside. Their interest rate, their price fell like a rock because people were so frightened. So the spreads were not seen in generations. And now they've narrowed significantly over the past several years to the point where you're not getting paid a whole lot more for taking more risk. The yield curve is a graph that represents the relationship between a bond's maturity and its yield at a given point in time. So this is also used to make comparison amongst types of bonds. Normally, and as we saw on the, we're going to see the graph in just a bit, but we saw in that chart from Fidelity, the yield curve is upward sloping. Longer-term bonds have higher interest rates than shorter-term bonds and treasury bills. Sometimes, though, the yield curve is downward sloping. It's called an inverted yield curve. Shorter-term bonds and bills have higher interest rates than longer-term bonds. That doesn't make sense. Why would that happen? Hang on a minute. Okay, so here is just an example of the upward sloping yield curve. This is normally what we see. Shorter-term bonds are paying much less than longer-term bonds. And this is basically what we're seeing these days. But sometimes we see the opposite. Sometimes we see a downward sloping, the inverted yield curve, where shorter-term treasury bills, shorter-term bonds are paying more than longer-term bonds. We'll come back to that in a bit here. Why do longer-term debt securities normally have higher interest rates than shorter-term debt securities? Well, there are three hypotheses, and they all make sense. In expectations, the shape of the yield curve reflects investors' expectations of what's going to happen in the future, and that's what a lot of investing is about, what's going to happen in the future. There's the maturity preference or liquidity preference hypothesis. Investors tend to prefer the liquidity of short-term securities and therefore require a premium to invest in longer-term securities. And again, we discussed that, right? That's why you pay a lower interest rate on your 15-year mortgage than if you get a 30-year mortgage. And then lastly, there's the segmentation, the market segmentation hypothesis, which says that the market for debt is segmented on the basis of maturity. There's a supply and demand curve within each segment determining the prevailing interest rate. In other words, people are interested in 2 years or 5 years or 10 years. And each of these three theories makes sense. Each has its merit, but how do we account for the times when the yield curve is inverted? What factors could cause an inverted yield curve to occur? And what can the yield curve tell us about the future of the economy? Well, dear students, since World War II, every time the yield curve has inverted, short-term rates were higher than long-term rates, the economy has fallen into a recession. There was only one exception, and that was 1966, where the economy just didn't go into recession. It just hit zero growth. It just basically touched zero. Didn't go negative, but then came back up. So every time. So the yield curve is watched by economists and by investors and by politicians, certainly, because it's a pretty strong indicator of what's going to happen in the economy. In 2019, ever so slightly, the yield curve inverted, causing renewed fears of an imminent recession. And of course, this was right before the 2020 election, and then the sitting administration does not want to see a recession happen in the year that they're going to be running for election. But then it reversed strongly. Why? Because of COVID. Yeah, right. For about 2 years before the beginning of 2018, the yield curve was slightly inverted. And, folks, the bond market, which is, we like to see, most of us don't think about the bond market too much. We really think about the stock market. But the bond market is so much more important. It's a whole lot bigger than the stock market. Why? Because if you can't borrow your money to get from point A to point B, you're in trouble. And when those people who are running the major corporations and the municipalities and the treasury can't get access to the funds, that's a serious issue. So the bond market is very important, even though it's not very exciting. We tend to watch the stock market more. But for 2 years, the bond market was predicting a recession. But the stock market, for the most part, just didn't believe him. It's like, hey, things are going great. What are you worried about? Housing? We're not interested in housing. Yeah. It wasn't until the fall of 2008 that the officials charged with tracking the economy acknowledged that we were in a recession. It took over 2 years, but the bond ghouls were finally proven right. Now, why would we call bond investors the bond ghouls? Well, think about it. What do bond investors love? Falling interest rates, because the bond prices go up, right? When do interest rates fall? When the economy is doing poorly, right? So, rightly or wrongly, we're often calling the bond investors bond ghouls. I don't like that term, but that's what they're called. So here is the yield curve as of October 2021, right? Oops, wrong. I have to change that date. My apologies. This is October 25th, right? Of today's the 27th. So I think this is a couple days ago. Here's the Treasury yield curve. Now, in the current one is the more blue one, and you see an upward sloping curve. A year ago, you saw the same upward sloping curve, but here in the 2 to 5 range, to 10 range, it was much less, paying much less. But now the 10 years, paying 1.7 or so, 1.6. But in 2019, before COVID hit, we saw a slightly inverted yield curve. You see that? You see the 1 month higher than the 3 month, higher than the 1 year, higher than the 2 year, 3 year, and then finally by 7 years it starts to creep back up again. Notice how the yield curve was slightly inverted in 2019, although there was much talk of a coming recession during 2019. Many experts were quick to point out that the yield curve could be inverted for quite some time before the economy actually fell into recession, which is what happened in 2006 and 7. 2020 saw COVID come onto the scene, and both ends of the yield curve collapsed as the Federal Reserve lowered short-term interest rates back to zero and bond investors braced for a pandemic-induced recession. So you see what's going on? Bond investors are thinking about the future just like stock investors. And if you're feeling, believing, thinking, whatever, that there's a recession coming, you're going to want to load up on long-term securities, because long-term bonds, because those prices are going to rise the greatest. Remember the seesaw? When interest rates fall. And these are people who are more interested in bond appreciation. They're often called bond traders, bond speculators, bond ghouls. Yeah, that's the yield curve. So watch the yield curve and weep and gnash and beat your breast, gnashing of teeth, as the economists do when the yield curve inverts. All right, let's turn our attention to bond valuations, because this is probably the most sexiest, exciting part of bond investing, and it turns out it's really not that exciting. Bonds are normally priced according to the present value of their future cash flows. Does this sound familiar? I hope so. Remember, we're going to get semi-annual interest payments we can think of it as annually, but they actually pay us every 6 months. And then we get our principal back, our repayment of principal. Although other factors will always need to be considered, such as the credit worthiness of the issuer, because if an issuer runs into trouble, the price of their outstanding bonds are going to fall because investors will be afraid of default. Are you with me? Yes, we have to worry about the fact of whether or not we're actually going to get paid. But assuming we get paid, we use the same formula that we used for stocks. We take the present value of their future cash flows. So here's the formula. The bond price is equal to the present value of the interest income. We could think of those like we thought of dividends, right? What money is going to come in the door? And the present value of the repayment of the principal, and with the stocks, we use the expected future price, but that's very, very unpredictable. But we know, assuming the bond doesn't go into default, we know we're going to get our principal back. We know we're going to get $1,000 back. So it's a discounted cash flow model all over again. Annual versus semi-annual compounding. Since bonds pay interest normally every 6 months, we really should use semi-annual compounding, but it's a pain in the neck. That's why we have spreadsheets. Annual compounding is easier to compute and will give us almost the exact same answer. So let's calculate using annual compounding manually, and then we'll go to the spreadsheet and let the spreadsheet take care of semi-annually. So yes, we're going to see that we have a spreadsheet that's very, well, it's geared toward bonds, but it's same idea. It's going to do all the calculations for us. We're just going to type in the numbers. So here's a company you may have heard of, maybe not, Diageo. Have you heard of Johnny Walker or Guinness Stout or Captain Morgan's Spiced Rum? What else do they own? Yeah, they're a booze company. So you might be quite familiar with their products and maybe not familiar with the company. But they have a bond out there, according to FINRA, as of October 25th, paying 2.375%. So $23.75 a year. It's due in about 8 years, 24th of October. Price to yield 2.086. So our current yield is 2.327. It's rated A-, so it's an investment grade bond. You know, A- is not that great, but it's certainly better than non-investment grade. And since 2.086 is close to 2%, we're going to use 2% for 8 years. So this is why spreadsheets make the life a lot easier, because we would need a huge table to do all the different interest rates. We just have a single table, a single sheet table for this chapter. So you're going to want, not right now, but you're going to want, when you go through the worksheets, to have the present value tables from this chapter, chapter 9, printed out. Or just make sure they're easily accessible. Because we're going to do the exact same thing we did in chapter 4. We're going to take the present value of the interest income, which, remember, it was dividend income when we talked about stocks. Now it's interest income. And then the present value of the repayment of the principal. Instead of the expected future stock price, we're using the future repayment, which we have a fairly good idea we're going to get. Right? We believe we're going to get that $1,000 unless the bond goes into default. So we use two tables. Why? Well, we could use the same table that we used in chapter 4 for everything, but that would mean we'd have to calculate the interest payment 8 times or 20 times or 30 times, depending on the life of the bond. So we have this new table on the left-hand side that is the present value of a stream of payments, not just one payment. That the table from chapter 4, we just did one payment. And we're going to use that table for the repayment of the principal. But the new table on the left-hand side tells us the present value for a series of payments. And that's what bonds give us, right? They give us They give us the same amount. They're fixed, in this case, $23.75. And so we go across to 2%, the price to yield value, down 8 years, and we see, and you can do this, do this on your own, but do it, and you'll do it for the worksheets, that the present value multiplier for that stream of income, those stream of interest payments, is 7.325%. I'm sorry, 7.325, right? I'm on the percentages, 7.325. So we multiply $23.75 times $7.325, and we get about $174, $173.97 or something like that. Now, that's the present value of the interest payments that we're going to get over the next 8 years. Remember that we took the present value of the dividend payments, but that's what stocks pay. Bonds pay interest. So now, what else? We know we're going to get $1,000 back in 8 years. Diageo is not going to go out of business anytime soon unless people stop drinking booze, and I don't think that's going to happen. So we know we're going to get our $1,000 in 8 years. That's the single payment table. That's the table on the right. So we'll go across to 2% down to 8 years, and you should see 0.853. That's $853. 1,000 times 0.853. Some of you can do that in your head, but use your calculator. You add those two numbers together, the amount we believe or we calculate the interest payments to be worth today, and the amount that the prepayment is worth today, and we get a bond that should be worth about $1,026.97. Okay. The quoted price on FINRA October 25th was $1,020.61. You're pretty darn close, right? And the bond calculator spreadsheet, which there's a presentation on how to use it. It's very simple. Gives us $1,021.09 for annual payments and $1,021.91 for semi-annual payments. So you see, very close. Why is the semi-annual payments prediction a bit higher than the annual payments prediction? We are getting paid every 6 months instead of having to wait until the end of the year to get our interest. So it turns out that, yes, bonds are very boring. Why? Because they're fixed. Whereas with stocks, it was open-ended. We don't really know what we're going to get. We don't know what the price is going to be in 3 to 4 to 5 years. We really don't know that they're going to continue to raise their dividends and by how much. But with bonds, we know, unless the bond goes through default, in which case, all bets are off. But most bonds get through their lifespan without any major incident. Yes, bonds are boring. And some people, they want to sleep well at night and they know they're going to get paid. So now let's take a look at some odds and ends as we finish up our discussion of bonds. Reinvestment risk is the uncertainty about the future value of an investor bond's investments that result from the need to reinvest bond interest payments and redemptions at yields not known in advance. Huh? Well, relax. Changing interest rates don't only affect the price of the bonds. They also affect your future income as you need to reinvest the interest income in bond repayments. If interest rates have fallen, although bond prices will have risen, hooray, your income level will fall as you reinvest your income in bond repayments. Likewise, if interest rates have risen, although bond prices will have fallen, oh boo, your future income level will rise from reinvesting in higher paying bonds. So yet, this is another example of why it is important to keep a long-term perspective. You see, people tend to think short-term and, oh boy, interest rates have fallen. My bonds are worth more. But now I'm going to get less interest going into the future because interest rates have fallen. Oh pooh, interest rates have risen. Oh, my bonds have fallen in value. What shall I do? Sell. No. Future bonds, as you reinvest that, the income and the principal repayments are going to be paying you more. Take a long-term perspective, dear students. Duration. Duration is a measure of bond prices' sensitivity to changes in interest rates and bond yields. This captures both the price risk and the reinvestment risk. It's used to indicate how a bond will react in different interest rate environments. The duration of a bond changes as it approaches its maturity date and current interest rates change. In general, the longer a bond's maturity, the longer its duration. The higher a bond's nominal rate and yield to maturity, the shorter its duration. And the shorter the duration, the less potential price volatility, and vice versa. Now, we're not going to learn how to do these calculations. They're done by mutual funds, by pension funds, by life insurance companies, by people in the world of institutional investing. Why? Because they've got tons of bonds, right? We retail investors who do buy bonds, we usually just hang on to them. We don't care about the duration. But if you're running an intermediate term bond fund or a short-term bond fund or a long-term bond fund, you have to worry about duration. So if you ever become a professional, especially if you cater to bond investors, high net worth and bond investors, then yes, you're going to want to learn all about duration. But it's not something you have to worry about, especially if you, like most of us working grunts, buy your bonds through mutual funds. The mutual fund manager has to deal with it. Duration and immunization. Isn't that a great bond immunization? I love that. Like the virus? No. Investors who have a specified time horizon, for example, 5 years, they want to buy an intermediate term bond fund, can use bond immunization to increase the probability of successfully achieving their desired goal. You keep the average duration of your bond investments equal to your time horizon. You would thus be more protected against interest rate induced price swings because you want reliability from your bonds. What's the problem? Well, it requires constant rebalancing of your bond portfolio since durations of bonds change as interest rates change and bonds get closer to maturity. So who's going to use this? Again, the mutual fund managers, the pension fund managers, and those individuals fortunate enough to have very large bond portfolios. Or if you become a professional who is well versed in bonds and you learn how to do this with your clients' very large bond portfolios. Now, let's take a look at the three major bond investment strategies. So this should have been percolating in the back of your head all along as we've gone through this, but let's codify it. Let's put it in stone here. There are three major categories, three major strategies. The income strategy, where you buy your bonds for interest income. There's the capital gain strategy, where you are speculating about the future movement of interest rates, speculating that interest rates will fall because that will create a capital gains. And then there's the total return strategy, where you're purchasing bonds for both the income and the possibility of capital gains. So which is the easiest to implement? Obviously, income strategy. You don't care about what happens with interest rates. Hardest would be the capital gain strategy, where you're basically speculating. And can anybody predictably, successfully predict interest rates? There are people who are paid tremendous sums of money to incorrectly predict where interest rates will go. Can you imagine how much money they could make if they could correctly predict where they're going to go? And then total return is somewhere in between. And you will often see a mutual fund, the total return bond fund. What they're telling you is, hey, we're interested in income from our bonds, but we're also trying to do a little bit of speculation to maximize your gains using capital gains, maximize your returns using capital gains. So you decide which is the best for you. Most bond investors choose the income strategy because that's why they buy bonds. Another strategy is called bond laddering. This is a strategy of purchasing bonds with staggering maturities. You purchase some bonds with short-term maturities, some with intermediate maturities, and some with long-term maturities. So it's a diversification strategy. Again, it's very popular with mutual funds, pension funds, since they have considerable sums of money to invest. The advantage is that it's diversified. The disadvantage, it's diversified. Huh? Well, diversification is a wonderful thing, but it keeps our returns fairly muted on the upside, but more importantly, it keeps our returns muted on the downside. And we're going to in a couple of chapters, we're going to throw everything together. We're going to throw it all together, go back over and tie it all together when we discuss in detail diversification and asset allocation. Cool? Okay, so here is an example of what kind of, this is basically the yield curve, what kind of bond ladder can create for us. We have some short-term securities, treasury bills, paying almost nothing, but they were paying basically nothing from 0.01 there for a while, but now 0.04, oh boy, 0.06, 2 years, not much better. Finally, we get to the 5 and 10 year paying not much better than what savings accounts used to pay us, but they're not, savings accounts aren't even paying that much anymore. And finally, when you get out to the 30-year A corporate, oh my goodness, 3.99%. Lock in your money for 30 years at 4%. Oh, well. So that would be your ladder. Oops, my apologies. Go back. Come on, go back one. That would be your ladder. You would have some short term, some intermediate term, and some long term. And I'm not a big fan of bonds these days, but that's what the world is paying us. And someday interest rates are going to rise again. Please, please, because that means the economy will be a lot stronger than it is. But there are many people who believe that bonds are in a tremendous bubble. The interest rates are so low, bond prices are very high, and that it's going to burst. We'll see. I don't necessarily believe that. I just believe that we have a long way to go before the world is normal again. Which, will it ever be normal again? I don't know. We'll find out. I don't sound very optimistic, do I? But I am optimistic. I don't. Yeah, we'll see. We'll see. My apologies. Okay, finally, we finished up bonds. So, to review, bonds are boring, bonds are stodgy, bonds are reliable. Go back over, do the worksheets, do the bond yield calculations, and then the bond valuation calculations. And in our next presentation, our next chapter, we'll discuss hybrid securities, preferred stocks, convertible preferred stocks, convertible preferred stocks, and convertible bonds. The best of both worlds, the worst of both worlds. Thank you, as always, dear students, for being in our class, and keep studying every day and bring honor and glory to Southwestern Community College.